What makes a good fund manager? This is what generations of financial advisors have tried to answer. We're going to do it in the next 40 minutes. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. I'm Bryce, and with my co-host Ren, today we're speaking to Chris Cuffe about the challenges of manager selection, how to find great managers, why sometimes they are a bit weird, and why too much success might be your first sign to get out. Ren, good to be with you.
Bryce, good to be with you. This is a big topic, an exciting topic, a topic that is probably the biggest challenge for a lot of advisors. Trying to find good managers that will outperform, that will continue to outperform. We know that past performance isn't an indication of future performance. Well, there's been a long history of fund managers in Australia that have had their time in the sun, that have had big inflows, big outperformance, and then things have changed. And so manager selection is an iterative process. It's a constant process, and it's something that, I mean, to be honest, like a lot of clients, that's why they pay. That's why they pay big bucks for advisors to get it right.
Absolutely. Now, Chris is a pretty well-known name in the financial industry, but if you haven't heard of him, he has a pretty impressive resume. So he joined Colonial First State, as it is known now, when it was a small fund manager and had been spun out of the State Bank of New South Wales. He became CEO and turned it into one of Australia's largest fund managers at the time.
Give him his credit. It was Australia's largest fund manager.
Credit where credit's due. Credit where credit's due.
So after CFS, he joined Challenger, was the CEO there for a number of years, and then led the funds management arm. And then he retired, I guess, to focus on philanthropy. He started Third Link, the investment fund. It's a fund of Australian fund managers that donates the management fee to charity. A similar model that Hearts and Minds, HM1, and Future Gen have followed since. He's also the chair of Hearts and Minds Investments. He's an investment committee member of UniSuper. He's an investment committee member of the Paul Ramsay Foundation. To be honest, he's selected and he's assessed and selected some managers in his time.
He absolutely has. He's
a good person to speak to about this topic.
And if that wasn't enough, in 2017, he was appointed as the officer in the General Division of the Order of Australia. So really, there is no better person, Ren, to be speaking to when it comes to tackling the question around manager selection. This guy has seen them all.
So before we get into it, we want to say a massive thank you to our partners here at Basis Points, SIBO, Milford, and Orbis Investments. Without their support, this show wouldn't exist and it wouldn't be free for everyone to access. So a massive thank you to them for supporting the show.
And a reminder that all of the content here at Basis Points is available for CPD. It is approved by the FAAA. All you need to do is go to the link in the show notes or the description if you're watching on YouTube, and you can complete the quiz at the end of listening to this. We'll then send you your certificate.
Well, with that said, let's get to our interview with Chris Cuffe, founder and portfolio manager at Third Link Investments.
Well, Chris, welcome to Basis Points.
Thanks for having me.
So your career has been characterised by building financial services business, Colonial First State, Challenger, and you spent a fair chunk of time at UniSuper as well. Reflecting on all of that, what are some of the business lessons that you kind of take out of that?
That's a very interesting question. Well, certainly not to think of the world as static. You know, if you ever want to wonder about change, you work in financial services, the amount of change over the years is unbelievable. So just when you think you're in a groove for whatever you're offering as a product or service or thing, you know, the world does change regularly. I would say to never forget it's a people business. It's absolutely a people business. And, you know, it sounds trite, but I've only seen those groups succeed that really focus on adding value as opposed to enriching themselves. It is an industry that pays too much. I've always thought that. And so people can get more focus on their wallet than somebody else's well-being. So if you can conquer those things, you probably do okay. But it's just a changing industry.
Well, on that change, like where has the biggest changes occurred? Like what really stands out to you over that time?
Well, there's a few, but the big ones that come to mind is the rise of industry funds. I mean, we sort of hadn't heard of those 20 years ago type of thing. or a bit longer. But, really they're mutuals in a modern sense. It makes me, I was talking to someone today and we were scratching our head of how AMP, National Mutual, Colonial Mutual, how they gave it all away when people rated their reserves. But, they should have been having the mantle of what the industry funds are today. So the industry funds are massive. That has, together with the superannuation system, this huge pool of money has completely changed the investing landscape, and also well-worn, but the advisory industry is very different too. It's good advice these days as opposed to product flogging, so that's a key thing. But with I think, back on the industry funds, I think profit versus not-for-profit, that's changed the retail industry as we know. It's a lot harder now than when I started at Colonial First State, that's for sure. You're up against people who are doing it not for profit, which means straight away, and particularly as investment returns come down, means you've got to work a lot harder. It's just not a given anymore.
Can you just dig down on the financial advice side as well? Like, how have you seen that landscape change over time?
Yeah, well, the obvious thing, we've seen lots more regulation, which was needed. It was an industry, as you know, you could come into with virtually no qualifications 30, 40 years ago. You just called yourself an advisor and away you went. And a lot of the advice industry, I think, came probably from the insurance industry, which was, single product, single job, which was to sell something. In my experience now, obviously a lot of advisors have left the industry. Weeded out partly by regulation, but also I think the qualification side is much better now. So people are doing, real tertiary qualifications in advice, and it's truly about advice now, I think, rather than product flogging. I speak to many advisors. I've got a great deal of respect for the advisory industry now. The depth of knowledge they have across a wide range of things is fantastic. So look, it's really good. The problem we still haven't conquered, though, in the advice industry, there's a lot of people who need advice who can't afford advice, and their advice they need is really basic, probably. Certainly, I watch this space closely. I'm invested in a robo area that's trying to make this online, so you can sort of figure out 90% of what you need online, but we haven't really conquered that yet.
Yeah.
Well, I mean, you would have seen some great advice businesses rise and some others fall over your journey. What stands out to you as what makes a great advice business?
A great advice business, that's a good question. I think firstly that you're not trying to do things too much en masse. There's economies of scale in any business, but at the end of the day, an advisory business is a people business. You've got X amount of clients you can capably service. And if you start trying to get beyond that and turning it into a sort of sausage machine, I think it's tough and probably not appropriate. I think also it's definitely a lot better now with the technology. We've got great platforms these days that advisors never had in the past, so that makes it easier. But a great advice business is definitely not too many clients and really deeply educated people and with a bit of grey hair. I mean, I've often thought, well, what is advice? What's the true value add in it? Well, of course, you've got to have a technical understanding of what you're doing, and hopefully you can write numbers down that make sense. But a lot of it is going to be holding people's hands and interpreting a language which is a bit strange. A lot of the jargon in the finance industry, advice industry, is pretty jargony. To try and say that in a way that mum and dad investor can understand is a skill. Yeah. And holding the hand of investors so they get to understand that this is not an exacting science. You've got to be patient, got to take a longer term view, stick to your knitting, all those type of things, which isn't easy.
Yeah. So Chris, these days, as we said in the intro, you're founder of Third Link Growth Fund, you're the chair of Hearts and Minds Investments, you're an investment committee member on UniSuper, as well as the Paul Ramsay Foundation. So safe to say you have assessed a large amount of fund managers in your time.
Yeah.
So we want to spend some time, leveraging your experience to understand what makes a good fund manager. And I think that's a great place to start. What does make a great manager?
Well, if I take a slightly comical side, I've often said to people, the best managers I know are pretty weird. as in
Nice.
they can be so focused on their craft, if it's stock picking or securities picking of whatever type. They are just extremely focused people who really live and breathe what they do. So that's number one. I don't set out to look for strange people, but I do look for very focused people. And of course, you want those focused people to have their money where their mouth is. So if I'm assessing a manager or a fund straight off, there's 4 or 5 things that always come to mind. How much of your money you got in here?
Yep.
I want to know, are they mainly looking after one asset class, one fund? So are they dedicated to that? So often the well-worn path of fund managers, they start off somewhere, do okay. You know, it might be Australian equities, might be smaller companies, Australian equities, a niche area, and then they get good at it. And then they head to larger cap stocks, and then they've got an international fund, and then they've got something else, and they then turn into asset gatherers, which is very different to investment managers. So the best investment managers, I would like to see that their tombstone one day says they achieve great returns as opposed to a great amount of funds under management.
Yeah.
And so to get great returns, it's almost anti-intuitive, but in most asset classes, not all, you've got to keep the amount of money you manage down. So you don't want too much to manage, and to do that and to make it economically worthwhile for you, you've got to have a performance fee. And I've got nothing wrong with performance fees, other than a lot of them play with the maths and have poor hurdles and stuff like that. But if it's a legitimate performance fee, great. I want to see good fund managers feeding themselves well and keeping their FUM low, good returns going from there. So that's a few of the things. I mean, often though you do, I think us who assess fund managers, we often ask the wrong questions. Quite frankly, I'm not that interested in listening to what's in a fund manager's portfolio, because they're probably only going to tell me the good stuff anyhow, or they might volunteer a couple of things that didn't go right. But I'm not really interested in that. I'm really interested in, why are you better than the guy next to you?
Yeah.
That's what it's all about, because this is a less than zero-sum game. You know, investment management is, some people do it well, others don't do it as well. Take away fees, and it means on average the sector should do worse than, say, an index. If you're trying to beat an index, it'll be worse on average by the index, less the average fees. So I want to know why you're better than the guy next to you. You know, do you have better systems? Have you got more grey hair? Are you more patient? What is it? Do you have less stocks, greater convictions? So those are questions that really sort out the sheep from the goats.
Yeah.
So the majority of people listening today are Australian advisors who are maybe at a smaller scale but have a similar job to you, separating good managers from bad managers that they want to invest with. So if the right question to ask is, why are you better than your peers? What are some of the things you want to hear in the answer? But similarly, what are some things that you hear in answers that maybe say, that's a red flag?
To start with, as probably goes into that focus, team size. I don't care what people say, brands don't manage money. To me, it's individuals. So often an individual who does well and does it within a brand of their company, then people might think, well, it's the company and they can employ more staff, and this special herbs and spices that this person's got, 11 herbs and spices, they can, sort of package it up and write it down and give it to the person next to them. I don't believe that. I think managing money is very much a people business, and I just want to know the team's small. Small teams is what I look for. As I said before, I want to know how much their money is invested. I want to see a track record. I mean, people often say past performance is no indicator of the future. Well, if it's not, I'd like to know what is then.
Yeah.
I'm a big believer in past performance and how you've gone through different cycles and how you act under stress. That's a big thing for me too. Seeing how people acted during the GFC, during COVID, how their portfolios changed, stuff like that.
When you say you're looking at track record, what length of time are you looking at?
So when I choose a fund manager, I'm saddling up for 5 years minimum.
Yeah.
So that's a minimum time period. If at the 3-year mark they're not coming up to expectations, I'll be talking to them more. I'll be trying to figure out their reasons why. But really, funds management is an inexacting science. Great managers, in my view, have poor years as well, or their sector's out of focus, or, great example now, the smaller companies area for the last few years has been not a great area compared to the overall market. Overall market's been dominated, as we know, by the big banks and the top 20 stocks. But there's great smaller company managers. They'll come back into vogue with it as sure as night and day. So you've got to go through full cycles for that type of stuff.
The advisor ratings companies have a pretty big impact on, how advisors can select fund managers and whatnot. How much stock do you put on fund ratings?
I probably put more, surprisingly, than people would think. I think they do a pretty good job.
Right.
For a group of people who aren't paid anything like the sort of the great fund managers, or there's plenty of well-paid fund managers, but they're not. It's not sort of the same there. But I do think, like, if I want to find out about a particular fund manager or product of theirs that I'm interested in, the first thing I will do is go and read the ratings of Zenith, Morningstar, whatever. I learn a lot of pretty good basic stuff from that. But what I have also learned is that the research industry, in the main, is a trailing industry, if I call it that. They're judging, writing, opining on things of the past. It doesn't necessarily get into stuff that's more a sixth sense or a gut feel. I can read a rating report, get up to speed with the basics, and then I want to sit with the manager and talk more about things that I might pick up in body language or style that just wouldn't be in a report. But I think they do a really good base job. I think it's very good.
Yeah.
Underrated sector.
No, nice.
Okay.
Well, although having said that, it's interesting that ratings houses, as you guys would know, private equity has been buying and owning those.
Yeah.
Over time, there's very good returns through the owners if you do your work right.
Yeah.
Well, Chris, you mentioned it earlier, your work at Third Link. So we want to turn to that. For people who are unfamiliar with Third Link, can you just introduce us to the concept and I guess what inspired you to start it?
Yep. Okay. So I set up this fund called Third Link Growth Fund. I set that up in 2008, which was a interesting time because the GFC came upon us, so that was great timing. And I set it up as a fund of funds. So I had been in the industry for many years, even back then, and I wanted to put together a fund which invested in what I thought were really high quality underlying fund managers that I had chosen based on my experience with them. This is an Australian equity fund, so it's an Australian equity fund of funds. So I wanted to pit my skill set, if you like, to find great Australian equity managers for my fund to invest in each of those, and then to ask the manager as part of the deal, would they waive their fees, both management fees and performance fees, and the fee my fund charges would go to charity. So by doing that, I was basically getting the services of fund managers, great fund managers, for free, and the investor hopefully getting a good return, but the fees they pay was going to charity. So that's how it's worked, and so since then we're 17 years forward. My fund has given 23 million away, just over 23 million away to charities over that time. It's been great. The fund is about 160 million in size. I'm trying to grow it a bit more at this point in time. But for people who want an investment in Australian equities, and obviously they're trusting my judgment in picking the right people, but you're actually accessing the real key to this fund, apart from the charitable side, which is certainly a feel-good side. But the real key is you're accessing managers that if you had gone directly to, you would be paying not just a management fee, because my fund's got a management fee, so you'd be paying that. If you were going directly, you'd be paying a performance fee as well. And the performance fee is often quite, in good years, that can be large. Through my fund, investors can access managers without having to pay their performance fee. And it becomes a one-stop shop too, because I have about a dozen managers underneath, so through a single investment in my fund, if that suits a person who wants Australian equities, they get access to a dozen underneath. All the paperwork's rolled up. It's only one tax statement, one this, one that. So it can be, a lot more convenient for people too.
We'll get to some of the fund managers in a moment, but back in 2008 when you launched it, how was the idea received by the Australian financial landscape? I mean, we look at where we are now, and there's a couple more, I guess, iterations. You're on the board for one, or chairman with HM1, and Future Gen is another.
Yeah.
So how was it received, and how's it changed?
Yeah, well, at the time of doing it, it was brand new actually, and my idea, I modelled it on a fund in the UK, which they're a little more ahead of us then. But so my fund was the first, but the prime difference is you can offer funds in the listed market or the unlisted market. Right. So this was the first of its type, and it was the unlisted market, which is the market I'm best known in. So that was unlisted managed funds. And then, later on, yes, we had Future Generations and Hearts and Minds and others come along in the listed market. But the unlisted market has advantages. One of the big advantages is we know it doesn't suffer the discounts that listed investment companies can have. LICs, listed investment companies, don't always have discounts, but it's just an extra layer of buying and selling demand that you've got to have over the top, where for an unlisted managed fund, you're in and out at NTA. So it saves a sort of area of complexity. But I think as a grouping together, Hearts and Minds, Future Generations, Third Link, we're now giving away tens of millions of dollars per annum. And so it's great. It's turned out to be good. But the key's got to be, I never wanted to do this and be a sort of soft touch, or I wanted to make sure investors were getting good returns. That was number one. The charitable side was always number two.
Well, if it is number two, it's still a strong number two. Since inception in 2008, Third Link has donated $22.2 million to charity. Correct me if I'm wrong, but
that's slightly out of date, but it's good enough. We'll call that a rounding error.
So, often we talk about abstract numbers and they sort of lose their meaning. So help us add some meaning to that $22.2 million number. What's some of the charities that you're supporting and some of the work that you've made happen?
Yeah, always. I have supported different charities over time. My starting point is normally they tend to be smaller charities that struggle to raise money. To date, it's generally been an interest in helping kids, teenagers with various things outside medical issues, so employment, Indigenous stuff, mental health issues. That's tended to be a theme, though I'm going a bit wider now. But some of the areas which have been great, when I look back, we've been a major supporter and catalyst for the existence of a group called National Centre for Childhood Grief, which is for kids who've lost one or both parents. It's a grieving counselling service that's been fantastic. We were an instrumental supporter in a group called Batir, which you might have heard of. Helps kids, particularly in high school, talk about depression more or mental illness more, and sort of come out and sort of share it rather than sort of hide about it. We've been a big supporter of of a group called AIM, which has helped get more Indigenous kids into universities. We've been a big supporter of Andrew Denton's Go Gentle group, which is a group formed to try and get voluntary assisted dying as law, which has had a great achievement with that across Australia. We're also supporters of, I'm a big fan of the Grattan Institute. I think they're a fantastic group that helps keep a lot of, keep the bastards honest. There's a lot of bullshit that comes out of Canberra, and sometimes you don't know what's fact or fiction, so it's nice to have groups around that are actually giving you the facts. So there's some examples.
No, it's really good. On the investment side, as you said, part of the idea here is to give us exposure to some of the best Australian fund managers and get good returns. So can you talk us through who you're backing at the moment? Who are some of the best Aussie managers?
Yeah, well, first of all, it's best in my eyes. Everybody's different, but these are people that, in the main, so I think I said before, there's about a dozen funds underneath. The number changes a little from time to time over the years. Some managers have left the stable. I've brought new managers in the stable. I tend to know them all to start with. They're well experienced people. Some of my favourites is a group called 1851 Capital, run by Chris Stott. I've known Chris for many years. In fact, he used to work for me when I was the boss of Challenger. But he specialises in smaller industrial companies. been going 5 years in his current firm. He used to work for Wilson Asset Management before that. Very experienced. In their 5 years, I think they rank in the top 3 funds in Australia in small companies. I love the way of his approach. Very smart guy. Got just about all his wealth in there in his fund. As I say, these are all things that made sense. One of the things I will say with Chris, though, he's not a weirdo.
Yeah, I was going to say.
He's a pretty good guy.
He's probably listening going like, hang on a
In fact, I also play golf with him from time to time.
Nice.
He regularly beats me, and I see how he studies a shot before he hits it, and that gives me a lot of confidence of how he manages money. But that's one of my favourites. Another one I've invested with for years is with a guy called Tim Carlton at the OzCap Group. Tim's, I think, a very good investor in that he is very focused on what the company's financials are. He tries to stay away from the sentiment of the market, and he's very strong on if there's good cash flow, good profits, manageable debt, and a good runway, he'll stick with companies for a long time. He runs a fund quite different to many others around town, where the turnover, he can be the one company for many, many years. So turnover can tend to be lower than other companies, but very solid results. If you look at his long-term results, really good. So managers like that. But as I say, there's a dozen there. They're all there for different reasons. I also tend to, of late, you asked me about research houses before. I look for managers also, not that I can't pretend I know all the managers around town. I do sit on enough investment committees, though, that I reckon you know a lot of them. I know a lot of them, but I do a good check each year with one of the research groups, Zenith, where we sit down and look at. They rate my fund, by the way, and it's got a recommended rating from Zenith, which is great. But they have a much wider view of the market, so we sit down, we look at managers that are emerging on the radar as doing well. There might be people I don't know very well, so I get to know pretty quickly. And they might help me if I'm having doubts about any manager. So that works pretty well to keep the knowledge base high there.
How long do you give a fund manager that is underperforming before you boot them, deciding between this is long-term underperformance or this is just a blip year?
Yeah, well, the first thing is whether it's something sort of structural. So the obvious things, if a fund manager is doing poorly outside of just the style, their management style doesn't suit with the market at the moment. So putting that aside, because I think that is always ironed out by the long term. But it can be staff changes, so critical. I remember seeing one manager a few years ago had a bad accident, basically off the air for a year. Divorce, believe it or not, or personal situations can cause distraction. As I say, I'm often betting on a single person. I'd say probably 75%. I mean, there's a number where there's a good duo, but I'm not betting on a team of 10. That's I just don't believe that. So what's going on in the individual's life is important. Markets do change. Like we have seen, in my view anyhow, we've had such volatility in the markets in the last few years, and this year, God, you've never seen volatility like now, that I used to be against managers that traded too much, but now I'm sort of a lot more comfortable. If I know a manager knows that particular stock well, got to know the stock well, and it's moving around all over the place, and they're buying or selling at opportune times, I think that's good. Whereas I've seen the sort of buy and hold manager that used to, I think, have a bigger place in times gone past. Still okay, nothing wrong with that, particularly as I say, I take a long-term perspective, but unfortunately others don't. So I'm investing in the underlying manager's fund, their existing fund. So if they're not doing well over, say, short to medium term, they're going to get funds outflow pressure. And that is hard on a manager. You don't want to manage a fund which has got consistent outflows. It's very hard. Yeah, the sort of buy and hold managers can get carted away a little bit. You've got to be a lot more nimble, I think, than previously. I hate to say that because I am a genuine long-term investor, but what I can do in my own portfolio is different to what a manager can do with a public fund.
So we've been speaking about Third Link, about the how you donate the management fee to charity. You've donated over $20 million so far. And we've spoken about how you select individual managers. But now we want to kind of broaden it out and talk about how you then think about portfolio construction at an institutional level, how you think about building out a portfolio of managers. So do you have any sort of ground rules or any frameworks that you use when thinking about it at a high level?
I do, but perhaps not as many as people think. I think so. I would say I'm not a funds management scientist that sits there and only plays with numbers.
Okay.
Because in days gone past, and this is true, if you were looking at professional fund-of-fund managers, they would often very deliberately mix a small cap manager with a large cap manager, with a growth manager, with a value manager, with a whatever else manager, and come up with a portfolio that they would think is in really good shape to weather the market. My experience in looking at portfolios like that over time was they generally didn't outperform the market. They might at best meet the market because it's almost a truism because they're putting a bit of everything in there. So you possibly got the market, and you would probably underperform again by your fees. So I sort of moved. I never quite bought into that, having watched people. But then I did see. I very much fell in love for a long period of time with managers in sectors where you can create a lot of alpha. Alpha, I'm sure your listeners know, is an amount of return above an index that you're aiming at. So that's the sort of value add. But and in particular, those who could add the most alpha, that most value add, tended to be in the smaller companies area, which was great. So, in the case of my fund, I was with a lot of managers in that smaller company area, small and mid-size, because that's where they could really outperform the market. And I wanted to get a market outperformance for my investors. So that was the logical place to pick. But we have certainly seen the last 3 years, the large cap managers do very well. And the smaller cap sector as a whole sector has lagged the large cap sector significantly. So my fund hasn't done as well over the last few years. Its long-term returns are still fine. But I guess there's a bit of a lesson there. Maybe you've got to have a little bit more in the bigger end. But I prefer the mid caps than the very large caps. But as we've well-worn commentary too in the last year or more, is this rise of just a couple of stocks. CBA is one everybody talks about. Look, I would imagine across my managers in my fund, there's probably no CBA.
Yeah.
So it means for us to have kept up with the market when that's now 12% of the index, it would have been pretty hard. But I'm not worried about that because things go up, things go down.
Yes.
Well, I mean, that sort of leads nicely into the active versus passive debate. You've got a portfolio of active managers. How do you think about that active versus passive debate? The index is obviously dominated by CBA at the moment.
Yeah.
But I guess both from your perspective as a fund of funds manager and then just generally for general investors.
Yeah, well, if I started the general, I mean, I think index funds have a reasonable place across the world. But when I say across the world, you do need to be in a well-diversified market or an asset sector where the number of securities is really important. Like if you're in fixed interest type securities, you want piles of those. And I think if a market is pretty diverse in terms of industry, stock size, that's fine. Nothing wrong with an index fund. Particularly as we know, most managers can't beat, most active managers in, say, equities find it very difficult to beat their index. I said before, it's a zero-sum game, so we shouldn't be surprised, but sometimes it is a bit surprising. But I'm in the camp very much of active management in Australia. And I say that because it's also very well known that our index, our main index, the All Ordinaries Index, is a very skewed index. So we know there's half a dozen stocks dominate it and two sectors dominate it, being banking and commodities. So if I had all my money in an Australian equity index fund, I would be worried, if I knew what was going on, that I'm very exposed to two sectors. So to me, that's not great diversification. So I would look for managers, certainly for my portfolio, that are active and have a track record to show that. I mean, you can say you're going to be active, but one of the things I do look for in portfolios too is a limited number of stocks. So the average manager out there in, say, Australian equities might have 40 or 50. I look for managers my sweet spot would be 15 to 20 if I can find funds managed by managers in that area, because I've got enough of them underneath that I'm very well diversified already, so I don't have to worry about diversification. I just want focus. That's what it's all about.
So as we sort of run through this episode, we're sort of building a criteria for what you're looking for. So like a concentrated number of stocks in the portfolio, a lead portfolio manager, or maybe a duo, but not a investment by committee situation. Yep. And you also mentioned a small team earlier, and a not too high AUM. Like you want good returns, not good AUM growth.
Yep.
Do you ever boot a manager just because they've got too big?
Yes, I have, and it's very hard, particularly when you run something like Third Link Growth Fund, because when I took the manager on board years ago, one of the things was to ask them to do something for free.
True.
So it's a bit like, it feels like kicking the family dog or something. But there's no doubt that in Australian equities, fund size, as in large fund size, is not your friend. It's a lot easier to manage smaller amounts of money. So the success of a manager through investment returns often leads to big inflows, bigger fund size, harder to manage. So there's a very well-worn cycle. So I'm always looking at fund size, and that would be a reason to let a manager go.
For people listening, like I guess for Aussie large cap, do you have a sort of number where you'll start scrutinising it a little bit closer? Like
I don't have hard and fast numbers. If I went sort of across the spectrum, smaller company managers, I think a good number is somewhere around between 500 million and maybe 750 million or something like that. Mid caps, it's can be a couple of billion, or probably a little bit bigger in the size of the companies. A good large cap manager can handle 5 billion of FUM, but past that, I'm starting to think, well, they must be pretty good to do that, because a lot of managers, as I say, if you to get alpha, if you to get this performance above the market, you've got to be doing something different to the market, which means you've got to be holding stocks in different proportions to the market, and a lot less stocks than what the market has. So you start to make very big bets. If you're managing $5 billion, and let's say you had a 20 stock portfolio, every bet there is, what's that, 400 million. That's reasonable size to start throwing around. So it's tough. It's a lot tougher.
Yeah.
With the world changing so fast, Chris, how do you ensure the fund keeps up with the evolving market, what's happening on us around the world, and sort of remains relevant to the investors?
Well, I guess the biggest thing for relevancy to the investors for my fund is it's Australian equities. So is an Australian equity exposure relevant to investors? Now, I'm not sure I can influence that, but we do know the health of the Australian stock market is pretty important. I mean, it is a shame that we're losing a lot of companies, either through M&A, other companies taking them over. We've lost a lot of companies. There's been an absence of IPOs in the last 4 or 5 years. So, it's hard. And meanwhile, the world stock markets have been bounding ahead in size, obviously, particularly out of America, led by the tech sector. So it's, I'm a big advocate of having a strong local market. Yeah. I think that's really important. And if I can have any influence on that through some of my activities, probably not Third Link, but, big industry funds have a lot to say in that. Government policy might have a say to that. Things like whether you're dual listed or not. It's currently a topic people are talking about. Seeing the IPO market loosen up more, which there's signs that that's starting to happen. That's all good. So if Australian equities is relevant, I would say my fund is relevant. Then I've just got to make sure the underlying managers are all still keen. Yeah. One thing too, an underlying manager who's really good, they can make a lot of money, and sometimes money does motivate a lot of people, surprise, surprise. And if they've made enough, they mightn't try as hard. So that's where you look for, again, either groups, people who are very hungry still, or you really do understand them well enough to know money doesn't drive them. They just want to win. They want to win the investment return game. They don't want to win the fund game. and they don't care how much money they have. They're the people to find.
How do you find them though?
Years of experience.
Yeah.
Years of. Well, you do tend to notice though. I mean, people who are really dedicated to their craft. It doesn't have to be investment management either. Whether it's a carpenter or a great artist or whatever. I said before, they become very focused. They are 24/7 people. You can bump into them in the street on a Sunday and they'll talk about stocks.
Yeah.
They eat and sleep stocks. They can't wait to anything. They're sort of junkies.
Yeah.
That's what you want.
Yeah, definitely.
It's come full circle. You started by saying they're a bit weird, and we kind of ended there as well. I guess, Bryce and I, when we sat out to sort of prepare for this interview, we really wanted to pick your brain on finding good managers, because that's one of the big challenges for advisors, navigating this world and then putting them together in a portfolio. And I think we've covered a lot today to sort of understand your criteria and what you're looking for. As we wrap up today, is there anything we haven't asked you or any insight you want to share with the advisors listening to help them navigate this world and find good managers?
Well, I guess one of the hardest things for advisors, if they find a manager who turns out to be really good, and as I say, it's a little bit of a trailing type of game. You're watching what people have done, rather than you can't watch what they're going to do, but you're trying to predict that. But if they're on a good manager, the problem is always the good manager gets too much fun. Too much money pours in, and then that cycle that their performance will tend to come off with size. So, my advice to advisors, or they'll have their approved product list or their research house they use. They have to stick with managers who will stick with a confined fund size, funds under management size, and again look for the warning signs of managers who are clearly turning into fund gatherers. I mean, I hate to say it, but one of my big red flags is when a fund manager lists on the stock market. It's not a good thing. It ends up as a conflict because their shareholders want to see growth in fund, because that leads to more fees. So it's very tough with that.
Yeah.
Well, Chris, to close out, how can advisors listening support all the work that you're doing?
If Australian equities exposure is what they or their clients are after, and if they like the sort of structure of Third Link, and if they have a belief I have any skill in this area, Third Link has a website, thirdlink.com.au, and everything is there. And what's interesting too, I don't know if I made it clear before, I said I invest in about a dozen managers underneath, and I'm in specific funds of theirs that are public funds that anybody else can invest in. So if people want to really interrogate my portfolio, they can just look into the portfolio of each of the underlying managers. So my structure and setup is extremely transparent, which I think people want to see.
Well, we'll include a link to Third Link in the show notes and YouTube description, and we had a look before. You can see the managers that you're investing with, and you also publish a quarterly report. So,
yes, and you can see all the charities we've supported over time, and
Love it.
Well, Chris, thank you for joining us on Basis Points today. We really appreciate you taking the time and sharing your insight.
Pleasure.
Thanks, Chris.
Good luck, guys.